There's no way to sugarcoat this. Things are getting quite bad in the Middle East. Oil prices made their biggest move in over 40 years in such a short amount of time. We're now facing supply shortages, which could very likely lead to higher inflation and as a result, rate hikes rather than interest rate cuts in the coming months. Since this war has now escalated beyond what most people expected and the market hates uncertainty, global stock market indexes like the FTSE All-World are now nearing correction territory, dropping close to 10% from their highs in US dollars. The same goes for the US-based S&P 500 index. The only reason our portfolios as European investors haven't been affected this badly yet is because the euro lost 4.6% in value against the dollar since the end of January. In today's video, I'm not going to try and predict the future or tell you about hot stocks or sectors, as that can change a few hours from now when a new Truth Social post or tweet comes out. Yes, I can't believe it either, but sadly that's the world we're dealing with right now. What I'd like to do instead is to provide you with some perspective and tell you how I'm viewing this difficult moment in time as a passive, low-cost ETF investor based in Europe. If you're new here, my name is Angelo. I've been investing in globally diversified ETFs for over 9 years together with my wife, and our own portfolio has been affected as well over the past month. Okay, let's get into it. Here's the first thing I want to point out. As bad as this feels right now, and I totally understand if you're feeling anxious at the moment, let me give you some context about market drops, as these happen on a regular basis. And yes, the reason why the market corrects tends to be a different one every time. A drop of less than 5% is typically considered a dip as it's normal volatility. After 5%, it's a pullback. At 10%, we're talking about a correction, and at minus 20% or more, we're talking about a crash. By that definition, we're close to correction territory right now, at least in US dollar terms. And pullbacks happen all the time. In fact, only 3 of the last 37 years have gone without at least a 5% pullback in the S&P 500. In other words, what we're experiencing right now is completely normal market behavior. As for how often corrections or crashes happened over the past close to 100 years, here's what the US data shows. Since 1928, the market has been down at least 10% 56 times, 15% or more 30 times, 20% 22 times, 25% 19 times, 30% 13 times, 40% 7 times, and 50% or more 3 times. Historically, the market has always recovered and continued higher after these drawdowns, no matter how bad they were in the moment. Still, I'm hoping that seeing this data serves as a good reminder of why you need to treat index investing via ETFs as a long-term investment, not something to jump in and out of based on the current climate or the latest news headline. That sort of behavior is very likely to underperform long-term. You should have a time horizon of at least 5 years, ideally 10 years or more. Because here's the thing, lower prices could be a gift in the long run. When prices fall, you're buying more shares for the same amount of money. Every time an automated recurring investment or a manual purchase is executed using your broker of choice during times like these, you are getting more shares of the best publicly listed companies in the world than you would have gotten at the highs. Speaking of that, you can find my favorite low-cost brokers in Europe linked down below, which is a great way to support me as I don't do sponsors. I know it's hard to have this perspective when you see a red number in your portfolio, but try to zoom out for a second. If you're not retiring at this very moment or in the near future, lower prices right now are not a problem as you don't need to sell. Instead, they could be an opportunity. Think about it this way. Would you rather buy the same ETF continuously at all-time highs or occasionally get to buy it at a 5%, 10%, 15%, or even a 20% discount? The answer might seem obvious when you put it like that. But in the moment when your portfolio is down and the headlines are scary as the world seems to be ending once again, our brains don't think that way. That's just human nature. And if the market ends up dropping 10% or more, which is always a possibility and nobody knows the future, here's what happened on average looking at historical S&P 500 data since 1950. Investors that bought stocks whenever a month ended 10% or worse below the highs were up an average total of 15, 42, and 72%, 1, 3, and 5 years later. When it was down 20% or more, they were up 17, 45, and 74%. And when it had dropped minus 30% or more, total returns were as high as 21% after 1 year, 48% after 3 years, and 88% after 5 years on average. As always, past performance doesn't guarantee future results, but at least based on what happened in the past, buying when others were fearful paid off most of the time. And the data confirms something really simple and yet important. If you're a long-term investor, market dips, corrections and crashes are nothing to fear or complain about. Instead, as Nick Majuli puts it in his book, just keep buying and stick to your strategy. At least that's what my wife and I have been doing the past 9 years. This time is no different for us. We continue buying our global ETF, both with our automated recurring investments once a month and manually whenever I have extra money since I am self-employed and get paid at random times. While it never feels great to see the portfolio in the red, not only on a monthly basis but also year to date, I'm confident this period will pass as well, and we're still up quite a bit overall with an average yearly return of 10.3% since 2017 as it stands. Right now, I can easily envision 2 scenarios. Scenario 1, the conflict with Iran in the Middle East resolves or at the very least de-escalates and oil prices start dropping again. This could lead to a fast recovery in the stock market and could put interest rate cuts back on the table. Or scenario 2, the war intensifies or drags on longer than expected and oil prices remain high or continue climbing. This would most likely pressure the market to go lower, and central banks may need to raise rates to fight rising inflation, something they're already considering. Which of these 2 scenarios do you think is more likely? Let me know in the comments. Whatever happens, it won't impact our simple long-term strategy. What we know is that based on over 100 years of market history, every crisis that ever felt permanent wasn't in the end. Even if it may feel permanent when living through it, as it does right now. And if you believe the world is about to end and things are only going downhill from here, well, then I don't know how to help you, and the value of your portfolio is probably the least of your concerns. I choose to remain positive about the future, just like all of the best investors I know and follow. I'd argue that's a better way to live life anyway, no matter what happens. I hope this video helped you put things into perspective a bit. Dips, pullbacks, corrections and crashes are a normal part of investing in a stock market. While you're still contributing to your portfolio, these should likely be viewed as gifts or discounts on the way to reaching your financial goals, not something to be afraid of, at least based on history. You can find my favorite low-cost brokers for ETFs in Europe linked down below, which is a great way to support me if you'd like to. As always, none of what I mentioned today was meant as investment advice. I'm just open to sharing my personal opinion based on my own experience as an investor. Thank you for watching, don't forget to subscribe, and until next time.